Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis with my podcast Money Talk for Friday the 18th of August. Welcome to the end of the week. This podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, one of China's biggest shadow banks has skipped payments on several investment products, sparking rare protests in Beijing as the fallout from a deepening property slump spreads to the financial sector. Videos of the incident appear to show about 24 protesters at Zhongrong International Trust demanding payments on high-yield products that were pitched as safe investments. Other retail investors sought to lodge formal complaints with authorities in Beijing. Japanese exports declined in July for the first time since February 2021, dragged down by waning demand in China for computer chips and automobiles, while imports dropped the most in nearly 3 years. Weaker demand in Japan's biggest trading partners in China and the rest of Asia has dimmed prospects for growth in the world's third largest economy. Exports from Japan dropped by 0.3% year-on-year in July, marking the first decline in 29 months. Hong Kong's seasonally adjusted unemployment rate edged down to 2.8% in the 3 months ending July from 2.9% in the previous month, and in line with market forecasts. It was the lowest jobless rate since June 2019 as the number of unemployed decreased by 1,900 from a month earlier to an over 4-year low of 111,700. Meanwhile, employment increased by 19,200 to 3.708 million, and the underemployment rate remained unchanged at 1.1%. On today's programme, I'm joined by Francis Lun, the CEO of GEO Securities, and Christopher Lee, partner at Farron, Augustine Alexander Investments. With a view from New Zealand is Mike Gibbs-Harris, director of MGH Asset Management in Wellington, New Zealand. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street, US stocks sank for a third session as long-term Treasury yields moved towards 16-year highs. The S&P 500 fell 0.8% and ended the session at 4,370. The S&P 500 is now down about 5% from its July peak. The Dow dropped 291 points, or 0.8%, to close at 34,475. The Dow joined the S&P, Nasdaq and Russell 2000 in closing below its 50-day moving average. The Nasdaq Composite declined 1.2%, falling to 13,317. All 11 sectors in the S&P 500 are on pace for losses this week in a broad market slide. The 10-year Treasury yield settled 3 basis points higher at 4.29%. That's its highest level since 2007, and rising yields have sent the US mortgage rate to 21-year highs. Yields on government bonds around the world also pushed to multi-year highs. UK 10-year gilt yields hit their highest level since 2008, and Germany's equivalents hit levels not seen since 2011. Onshore and offshore yuan weakened sharply on Thursday. Onshore yuan dropped more than 200 pips to break through 7.31 renminbi per dollar for the first time since November last year. The yuan then rebounded to trade at 7.291 renminbi after Chinese authorities told state-owned banks to step up intervention in the currency markets. Hong Kong stocks slid for the 5th session in a row after briefly hitting their lowest level in 9 months. China's Premier Li Qiang said Wednesday the country would work to achieve its economic targets for the year. He also said efforts should be made to organically combine security with development in the context of promoting business overall. The Hang Seng Index slid 2.3% at one stage in the morning session to break through the 18,000 mark and hit its lowest level since December last year. It then staged a sharp rebound to end the day just 3 points lower at 18,327. The index, though, has fallen 19.2% from the recent high seen on January the 27th. And it's near a technical bear market, which is defined as a fall of 20% or more. The Hang Seng Tech Index erased a loss of as much as 2.5% and was up 0.8% by the close. The Hang Seng China Enterprises Index, which tracks the largest mainland companies listed in the city, rose 0.8% but has plunged almost 9% this month to become the worst performer among 92 global equity gauges. Mainland stocks slid to their lowest levels in 7 months. The Shanghai Composite fell 0.9% to below 3130 at one stage in the morning, before recovering to end the day 0.4% higher at 3,164. Looking forward to this morning, maybe not, because Hong Kong stocks are set to slide for a 6th day at the open. Futures markets are pointing to a decline of in the Hang Seng of about 155 points. That's 0.9%. And you can get the latest market movements and all the details in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
It's a Friday. I don't know if it's a good Friday or not, but we'll find out soon. We have with us Francis Lun, the CEO of GEO Securities. Morning, Francis.
Good morning.
And also joining us is Chris Lee, who is senior partner at Farron, Augustine and Alexander Investments. Nice to see you, Chris.
Good morning, Peter. Good morning, Francis. Hi.
Good morning.
Shall we start with China? It's a little bit depressing this week, isn't it? All the news out of China. But let's talk about the home prices first, because it looks like the decline in Chinese home prices is accelerating, isn't it? Particularly in third and fourth tier cities. Average new home prices in China's 70 major cities fell 0.1% year on year in July, after edging up in the previous month. That was the 5th straight months of declines. But if we look on a seasonally adjusted basis, new home prices declined 2.5% month on month. That's increased from the fall we saw of 2.2%. And then in third and fourth tier cities, they saw drops of 3.9% and 3.3%. I mean, Francis, actually, I've heard people say that the numbers are actually even worse than what the official figures are saying.
Definitely. I think China has a serious problem of oversupply. I think for the third and fourth line cities, I think the oversupply exceeds something like 20%. You go to any China city, you see ghost towns everywhere. Those are the results of overbuilding, years of overbuilding. Actually, the first ghost city is in Outer Mongolia, near Erdos. It's still a ghost city after 20 years. So you can see with the population decline now, you're never going to take up all these vacant flats. So it's a grim future for the property developers.
Oh, Chris, what do you think?
I've not been to the Ghost City, but I've been to Zhongshan and some of the Greater Bay Area locations here. So the property agents have shared with me that the declines that they have seen in prices, right, have been more than 30%. So
more than 30%.
So these are basically some of the units that have been pitched and sold to Hong Kong investors. A year ago there was this big Greater China theme. So obviously there were a lot of property agents trying to market, right, these Greater Bay Area units to some of the Hong Kong investors,
right?
Because they're smaller in terms of price, right? So you can buy a unit for maybe $1 or $2 million, and some of those $2 million units, Hong Kong dollars, were sold at like less than 1.5 just in the recent print. So this is from a couple of real estate agents that I've spoken with.
So that means then this is not just a mainland problem; it's going to have an impact on Hong Kong as well.
If you go to the Exchange Square every day now, there are protesters protesting some flats they bought which were never completed.
And I suppose this is why Country Garden is in big trouble now, because they specialise in the third and fourth tier cities, don't they? That's where a lot of their projects are.
Yeah, they chose the suburbs where they can get large tracts of land, and they count on the cities being built up like the Pearl River Delta. But the problem is, if you leave the Pearl River Delta, many areas never really built up, like Nanning in Guangxi. Many developers went there to scoop large tracts of land. They never got filled up, and they lose big.
So, Chris, I suppose from a financial perspective, this also has an impact on the markets, doesn't it? Obviously, in the share price of the developers, as we've been seeing, but also in the debt markets as well. JP Morgan's raised its emerging market default forecast, mainly because of China's property sector. It's raised its global forecast this year to defaults of 9.7%, up from 6%. However,
very high.
If you left out Chinese property, that default figure would be just 1%. So it tends to show you just what a big impact this is having on the credit markets as well.
The credit market in China has been really difficult, as we know, in the last year or so, right? So Chinese property developers have not been doing well, and these are high-yield bonds, right? So there's another name for these high-yield bonds. These are junk bonds.
Junk bonds.
Junk bonds,
they really become junk.
AKA also known as very high probability of defaults. So it's not really a surprise to me that we're seeing a lot of these defaults happening. In fact, I mean, that was meant to be a high-risk, high-yield investment. And I think there was probably a disconnect somewhere during the process. You mentioned earlier, Peter, that some of these wealth management products were pitched to investors as rather safe investment. I think the disconnect was not about the instrument itself. The disconnect was really in the selling process.
Right. They've been missold,
product.
basically.
Yeah, they will tell the consumer that you can leverage it and borrow one time.
Oh, that's even worse, my goodness.
And many people got burned this way, especially the mainlanders. They slap up all these Evergrande bonds because they thought they were safe and paying 13%. Wow!
Is this how the contagion spreads from the property market to the financial market? Because you have these shadow banks like Zhongrong that we've been talking about, which have been selling, high yield products, but they're linked themselves to the property market, aren't they? Some of this money goes into these developments on the basis that these apartments are going to get completed and they're going to get a big yield back. So if they don't complete them or they default on the bonds, which these investment trusts are invested in, it has a knock-on effect, doesn't it?
Yeah, it's like a cascading market. It's like the dominoes, one falling after the other.
Big time. I mean, let's talk about these wealth management products, right? So what are these wealth management products? They are issued by these trust companies who basically take almost like deposit style cash from the average retail investors. And what do they do with that cash? They turn around and invest in all these high-yield bonds that are issued by Country Garden and that are issued by the Evergrandes of the world. And these bonds have not been performing well.
And then now Country Garden suspended trading in 10 of its bonds.
That's right. And that's why when these trust companies cannot pay interest, it's just to be expected. So because the underlying high-yield bonds, again, junk bonds, did not pay, and therefore these wealth management products cannot pay. And therefore, I think some of these very angry local investors are taking to the streets and protesting.
Do these trusts, because these trust companies are quite unusual in themselves, aren't they? Because they exist in the murky parts of the financial system, and they can invest in like pretty well anything they like, can't they? There's nothing they can't invest in.
Yeah, they're a virtual bank. And they what they call their shadow banking. And in good times they're okay, but in bad times they're bound to fail.
And do they have to write down the value of these investments? So if you hold these Country Garden bonds that have been suspended from trading, they're now, the last price was something like 10 cents on the dollar. Do these trust companies write down those and take the losses and admit basically that, we're invested in them and we're going to have to write them down and we can't pay out?
They should. I think they need to. And even though they are structured as wealth management products, so-called WMP, right? So these are the products that are managed by the portfolio managers. But again, I think going back to the point you made earlier, Peter, these were pitched, unfortunately, to local investors as rather safe investments by the banks who act as distributors. So there's another party here the banking sector, right? The traditional banking sector has been promoting many of these WMPs, wealth management products, to local investors. And so the mis-selling is something that we should not ignore in this whole process.
So there seems to be also then a failure of regulatory oversight here in the way in which they're sold, the investments that they do. And, if you promise... They're promising 10, 11, 12% guaranteed returns, aren't they? Which
you should be skeptical when you don't get any interest on your deposits like last year, and you're getting paid 10 or 12% on your investment product. There's got to be something wrong.
Well, they were even higher when these wealth management products first came out, right? So, and they were, I think, slowly decreasing the payout, and also because the high yield markets have not been doing well, as we all know, in the last 2 years. And relatively speaking, these wealth management products are still paying, I think, rather high yields to the investors compared to deposits. But again, the missing piece was high yield means high risk. Doesn't mean, low risk. And that was, I think, miscommunicated during this distribution process.
Yeah.
Do we have an idea of the scale of the problem here? Because Zhongrong, the one we've been talking about, they have about 1 trillion renminbi under management. That's about 140 billion US dollars. I mean, we could be talking about trillions of dollars here, couldn't we?
Tens of trillions, at least, because Evergrande is indebted to the tune of 2.4 trillion. And then Country Garden, the next one, is 1.4 trillion. So just two of them is almost 4 trillion.
So how big a problem is this?
So it's a big problem. However, I think, just to have a little bit of a positive spin on this so far, I don't think this will be contagious like the 2009 financial crisis in the U.S., because at least there are 2 or 3 reasons. One, I think the high yield bonds issued by all these property developers are not securitized. They have not been sort of like structured as collateralized mortgage obligations. They have not been repackaged. They have not been resold multiple times to other institutional investors. So that's, one thing, because
we hope.
Yeah, the securitization of these mortgage products don't exist, right, in China. So that's the good thing. The second good news is this is rather controlled because the renminbi is not convertible. So foreign investors, luckily that renminbi is not convertible. So in the capital account, so you don't see foreign investors buying mortgage-backed securities in China, right? And so unlike what happened in 2009, Lehman defaulted, and so all the MBSs and CBSs, I think, were basically affected. And the poor little old lady in Wan Chai demonstrated because of her purchase in mini bond. It was a global problem back in 2009. But here I see that the situation in China is very controlled and contained. Also because the third reason is these are mostly commercial mortgages and not individual retail mortgages, right?
I think it's only the Chinese investors, especially individual citizens, that hurt. They will lose their savings.
So this is going to be contained within China, but nevertheless, there's going to be a lot of very unhappy people who have lost basically everything on some of these products.
Definitely.
The government is going to have to step in, isn't it, and find a way of making them whole?
Well, I think there are 2 options, right? One is government can definitely do something here to help the corporate borrowers to probably make some of those mortgage payments. That's solution number 1. I think solution number 2, which I had seen, was the distributors, I think, should bear some of the responsibilities here, right? So if they have sold these as like safe investments to their wealth management product investors, and I had seen that distributors, came in and say, well, we know that the trust company defaulted and you bought it from us, and here's some form of a payment that will help you sort of like get back partially some of your investments. So I think that is another way that I think the investors can be compensated. But I think that will require quite a lot of coordination.
Yeah, but I think the Chinese government is content to let these property developers go into liquidation and bankruptcy. I think from what I heard this morning is that Evergrande filed for bankruptcy in U.S. courts.
So
that's really strange. Why in U.S. court? Why not in Chinese court?
Yes, yeah.
But because they just don't want to spend trillions of dollars to save these property developers who got themselves into this situation. It's their own fault.
Yeah, well, that's also the moral hazard issue, right?
Yeah.
So, Francis, I mean, if they save these guys, then what about the next one, right? So they have to, I think, let the market, let markets be markets.
Yeah, that's right.
But the problem is, even though then this is a China problem, it still affects the confidence of investors overseas, doesn't it?
Definitely.
They look at this, they think this is another big problem on top of all the economic issues that China is facing. This is a market that we're just going to have to avoid for now.
Yeah, Biden already told U.S. investors not to invest in China already. So we don't see any American or European money in the Hong Kong market now.
And foreign investors are pretty well completely pulled out, haven't they? I mean,
almost. Yeah.
Short term, definitely there are very, very, I think, a bearish, sentiment and also very bearish views. Now, the question is this a value play, right, over the medium term and over the longer term? Because fundamentally speaking, you see the growth in income over the last 2 decades. It's just that the stock market has not reflected the growth.
Yeah, there's enormous savings in the Chinese system.
But if you've invested in China over the last 20 years, you've pretty well gone nowhere, have you?
That's the problem.
But you're back.
In the stock market, yes.
Yes, in the stock market, yeah.
But however, you see the GDP per capita over the last 20 years that has grown tremendously.
Yeah, many times over.
That is the big disconnect that we see.
Yeah, the stock market is not doing well at all.
But even though GDP has grown, the problem is private companies have been really beaten up, haven't they, by the government? So they're not getting the benefit of that GDP growth, and they're actually being forced to, in effect, shrink. That's where the disconnect comes in, really, isn't it? It's policies that are not allowing private companies to thrive in this type of environment.
That's right. Yeah, I mean, the last 20 years, has been a growth story, right? So everyone is looking to China for growth and growth. But I think if you are the students of Ben Graham and all these value investors, then you would like to look at these beaten up companies that are fundamentally good businesses, but they have been just somehow punished by the stock market and also the investor sentiment. Yeah. So there is still, I think, value to be found.
But you may have to wait a while to realise that,
wait a long time.
As you do with value plays anyway. You might have to wait a long time.
You do have to wait. For our young audience, I think this is an idea, right?
They're not used to that.
Don't forget that the last property slump lasted from 1994 to 2006. 12 years.
Wow, okay.
Wow. So you're looking at that now.
So what about the Hang Seng? It's just, under 1% away from hitting a bear market. It's down about 19.5% from its January high. Yeah. I presume this is being hit from all sides, isn't it? From the declining economy, the poor data that we're getting, the geopolitical problems, the problems in the property sector. It's just hitting Hong Kong companies across the board.
But yesterday, we saw a change of direction.
Now, what caused that sudden rebound? I couldn't work out. I couldn't see any specific news or anything.
No specific news. It's just bargain hunting. It's too cheap.
Really? Yeah. Or was it state-owned mainland funds as well being ordered to step in and buy?
I think it's private money.
Right.
Because they concentrate on buying the internet stocks.
Right.
So I think as soon as the index fell below 18,000 boom, you have
because that's pretty where it bounced.
That's the trigger point,
Yeah, bargain hunting, right?
Yeah,
so going
right.
back to that value play again, and so it's not just for the medium and long term. There are also momentum traders who are looking at this type of
Hong Kong
entry
stock is
points.
too cheap.
But where were the buyers coming from? Mainland?
I think
or-
China, yeah.
Mainland China.
Yeah, that's right.
Because I was surprised, at lunchtime, early in the morning, it was looking pretty grim.
Yeah.
And then by lunchtime, it pretty well made back everything it
Yeah,
lost. But
that's
on
right.
no specific catalyst, or I couldn't find a particular news story that
No news
really
story.
caused that big
Well,
bounce.
welcome to the markets.
Oh, yes. Well, the same thing happened in the yuan as well. The yuan.
I think it's going to hit 7.4.
Now, tell me something then. Why is the government not pleased that the yuan is sliding? Because you would have thought that for a country that's in deflation, the best thing that could happen for it is to let the yuan slide, which would give a boost to the economy. I mean, look at Japan with the Japanese yen.
Yeah,
The
that's
sliding yen has helped Japan. Why are they afraid about the yuan sliding and doing all these steps to try and stop the slide?
I think it's not good for confidence. When you have a weak currency, you look weak globally, and so don't forget, some years ago the yuan was trading at 6 point something to the US dollar.
What do you think, Chris? I mean, how big a problem is this for overseas investors? I suppose they see the Chinese yuan, and on top of everything else, that's another reason to stay out.
Not positive, right? Not positive. But I think, again, if you try to put a positive spin on this, right? So the weaker the currency, I mean, it would supposedly help more exports, right? So that's, I think, something that I am looking forward to. I know the domestic consumption has been the main theme in the last few weeks, and also the historical growth thesis has always been the export-driven sector of China. So we like to see more exports also, and I think there will be still many European and also U.S. Consumers benefiting from the low cost and also high quality products from China.
Well, look how it's helped Japan. I mean, the sliding yen there, the yen's down about 11% year to date. That's given a big boost. I mean, look what we saw on GDP, 6% in the second quarter, boosted by largely by exports, particularly cars. So you would think that this would be also a beneficiary for China, a sliding yuan. When you're in deflation, what you want is a weaker yuan, isn't it?
And also stock market, the Japanese stock market is 30-year high.
Yes.
Yep.
But presumably there's another problem, which is why the yuan is going to slide. US Treasury yields have hit 16-year highs. So now the difference between US yields and Chinese yields is also at multi-year highs. So that's going to push the yuan even lower, isn't it?
Yeah, the yen will come under selling pressure today, definitely. You have a mortgage rate at 7% now. It's 21-year high.
Yep. Now that has implications as well, doesn't it? These rising Treasury yields now, we're now firmly above 4%. We haven't seen 10-year yields above 4% since the global financial crisis, when the central banks basically started slashing interest rates. But we're now, it looks like we're going to be at above 4% for quite a while. This is a game changer for the markets, isn't it?
Definitely. I think some people look forward to rate cutting next year. Maybe they
have to.
Overly optimistic.
Right. So this is a very strange situation, right? So Peter, you mentioned the 10-year yield at 4.29% earlier. So we see a V-shaped yield curve, right? Because the short end 6 months is about 5.5%, and at the peak of like 6% at one point. And then the long end of the curve is at 4.4% or 4.5%. This is not a sustainable shape, right? So it's not upward sloping, it's not downward sloping, it's a V-shaped curve.
Right, yeah.
So I think the normal shape should be an upward sloping curve. So the short end has to come back down to 3% or lower. And so I think I think I would be putting my money on at the middle or later part of 2024 they will have to start cutting rates in the U.S.
But when 10-year bond yields are around 4.3%, but the Fed fund rates is over 5%, inflation is still over 3%, it suggests that these yields could go higher yet, couldn't they?
Yeah, the core inflation is still something like 4%. I think that is the problem. I think one of the reasons ascribe to high rent. I think in the U.S. rents are still very high because of the influx of illegal immigrants. And so unless you can solve that problem, I don't see rents coming down.
Right.
There is a lot of pain, I think, experienced by the average American household because, as you mentioned, the Fed has raised rates by more than 500 basis points, right, since March 2022. So, assuming that the average home price is roughly $300,000 in the U.S., so the mortgage payment by an average American family has gone up because of the rate increases. So it's gone up almost like $700 to $1,000 per household.
Right.
And that's extremely painful to the average family. It may not be a lot for you too, but it's very painful for the average family.
Yeah.
Well, in the US last night, the average 30-year fixed-rate mortgage rose to 7.09%, according to Freddie Mac. That's a 21-year high.
Yeah.
Yep, and it was half of that before, I think.
Yeah, before it was something like 3%. Yeah.
So the highest basically since 2002. That's going to cause pain, isn't it?
Lots of pain.
Yeah.
But in the meantime, on the mainland, they're cutting interest rates. We had this 15 basis points MLF cut earlier in the week.
Yep.
How's that going to help?
That's not going to be enough. I think you have to have a big spending program, like something like 4 trillion yuan that was launched by Premier Wen Jiabao many years ago in 2009. I think you need something like that to revive the economy.
Yeah. And domestically, it will help, right? So people will go out and spend more. But I think we are still not seeing enough foreign tourists going to China.
Right.
And I know people in Hong Kong go to Shenzhen almost every weekend because fortunately we can use the Hong Kong version of Alipay app and WeChat app to get taxis and stuff. But think about an average tourist from Australia, from UK, from the US. If you don't have the local bank account, it's almost like you can't do anything.
Right.
They don't accept cash.
That's the problem. So they don't accept cash, and so if they don't accept credit cards either in a lot of other places.
That's right.
So even the street people would ask you to scan a code to just pay the homeless people. So they have to. I think this is an easy fix, to be honest, because we just have to welcome foreign tourists who don't have the local payment system to spend money, and this is a policy thing that can be fixed by the government.
Yeah.
What did you make of the activity data that we saw this week? Retail sales, fixed asset investments, property investment as well, industrial production, all disappointed, didn't they? It was like a trifecta of disappointments.
It really showed the Chinese economy is not doing well. I think, especially the export sector. That's because lower demand from the rest of the world. That's something that you cannot do. And that plus the property slump. And then, of course, the population decline. So you really need something, doing something major to other than saying all these slogans. I don't know how many points, 31 points or even 100 points. They're no use.
Well, that's why I think having the renminbi depreciate further would actually boost the export sector.
You would think so, wouldn't it? Yeah.
To reactivate the export sector, because that has been the key, I think, the four-cylinder engine, right, that has been driving the economy for many years. I would be happy to consider buying a BYD electric car. I've seen them on the streets.
Yeah, it's on sale in Hong Kong now.
Exactly. So if they can be sold here in Hong Kong, there's no reason why they cannot be sold in other countries, right?
Yeah, I think the first half of the year, China exported more than 2 million cars to the rest of the world.
Right. Isn't part of the problem, even if the yuan were to decline and exports were to become more competitive, there's such Well, there's two things. There's, first of all, Americans and Europeans aren't buying so many goods anymore anyway. They're going to restaurants and travelling, but they're not buying goods. But secondly, there's been such an anti-China sort of government-provoked sort of backlash against buying Chinese goods that they're avoiding Chinese products anyway, even if they are cheap. So it's sort of hurting China quite badly, isn't it? These geopolitical tensions.
That is not something that you can solve overnight. I don't think so. But the problem is China makes half the world's manufactured goods. You cannot.
You can't avoid them.
You can't avoid. Yeah, we saw that in the 1980s when I think Japanese cars were getting the love and hate relationship with American consumers. Yeah. And I won't be surprised. I mean, if people have that love and hate relationship with the electric cars from BYD.
Yeah. That's right.
Yeah. Well, the data though was a little bit overshadowed, wasn't it, by this news that they were going to stop releasing the unemployment data for the 16 to 24-year-olds, the youth unemployment rate, which we can only presume is because the number was so bad. It was already at a record high of about 21.5%. What do you make of that?
It's going to get worse. I think I told you last week that the youth unemployment rate is more like 50%. Half the graduates cannot find work.
Yeah. So there's also this idea of how do you define employment nowadays, right? Because gone are the days that my dad worked for a bank for 30 years and then he retires at the age of 65. And nowadays, I think people have so-called like a portfolio career and they work for multiple jobs. And it's, again, to your point, a gig economy that we talked about earlier. So while they are technically unemployed, but they may still be getting some form of incomes from either their social media channels and also getting some form of payments from tutoring. And so they are still making some form of income, but it's not officially recorded as a full-time employment.
That's right.
But the thing is, that's all being said. What they could have done was carried on publishing the data, but said we're now reviewing the methodology behind it and we're going to make some changes to it, rather than stop reporting it completely. Because if, on the one hand, the government says we want to attract foreign investors into the market, but then they say we're not going to give you the data that allows you to make rational decisions about whether or not you should be in the market, it just doesn't go together, really, does it?
Yeah, that's a typical bureaucratic reaction to something bad.
What, to just stop, try and hide it?
Try to sweep it under the rug.
But it doesn't make all those unemployed people disappear. They're still there and they're still unemployed.
That's right.
Yeah, and it will be higher, right? Because, where are you going to find jobs for 13 million university graduates every year? I mean, that's the number. So everyone is going to university and everyone is going to college. And
that's right.
Many of them are over-educated and underemployed and working at coffee shops, right?
Yeah, so they need more vocational training. This is like Germany does, which is very good at vocational training, actually training people with specific skills for jobs. Surely that would be better than just putting everyone through university to get these weird degrees in whatever they are. I don't want to say because I'll upset someone if I mention a weird degree, I'm sure, but you know what I mean.
Yes, I think the German model, the Switzerland model, and the Austrian model, I think those are the three countries that I know that have really strong vocational apprenticeship training.
Right. Well, look, thank you very much. Great discussion there. We covered a lot of topics, didn't we? Have a good weekend. Let's hope the news is better next week when we return on Monday. You heard there Christopher Lee, who is Senior Partner at Farron, Augustine Alexander Investments, and Francis Lun, who is the CEO of GEO Securities. I'm joined now by Mike Gibbs-Harris, who is Director of MGH Asset Management down in Wellington, New Zealand. Morning, Mike.
Morning, Peter. How are you doing?
I'm very well, thank you. Let's start talking about New Zealand, first of all, as you're down there. The Central Bank, the Reserve Bank of New Zealand, held its benchmark policy rate at 5.5% for the second meeting in a row. We sort of watch this quite a lot because it's probably fair to say, isn't it, that New Zealand has been among the most aggressive central banks in the world, if not the most aggressive in raising rates to cut inflation. But it seems to be signalling now it's happy with the job it's done.
Yeah, but Its target is to bring inflation down to 1 to 3%, and historically the last few figures have been above 6, but they think that inflation will get down to under 3% by the third quarter of next year. So they're prepared to go and leave rates where they are whilst we get there. They've said that if necessary they'll put rates up if inflation sparks up, but there are signs that the New Zealand economy is weakening, so they're prepared to wait rather than push interest rates up much higher, much more quickly.
And if the data that comes out over the coming sort of weeks doesn't confirm that and doesn't confirm that inflation is coming down, are they going to be back on the interest rate hiking path again?
I think they consider. I think it's unlikely that we'll get a further interest rate hike this year, unless the inflation figures are much higher than people are expecting. Partly because there's an election due in mid-October, on October the 14th, and I think that that they'll probably be wary of increasing rates ahead of that.
And what's this all doing for the economy? The economy, I think it's slipped into recession, hasn't it?
It was in recession earlier this year, then it sort of climbed out, and in fact the Reserve Bank is expecting there to be a recession in the second half of this year. It's looking for minus 0.1% for the next quarter, minus 0.3%. For the quarter after that, so it's not a savage recession, but the economy is not doing well at the moment. There's a couple of reasons for that. First of all, the slowdown in China doesn't help because that's affecting New Zealand's biggest export, which is milk powder. The fact that the housing market has been fairly weak. Prices are off quite a lot, and although there's some talk that we're close to the bottom of that, that's affecting consumer confidence, and industrial production has been falling as well. So there's probably not much sign of a big pickup in the economy at the moment.
And what about the dairy trade? Because that's a big part of New Zealand's economy, isn't it?
Yeah, it's about 25% of its exports are milk or milk-related. And the milk price, on the traded milk price, has basically halved in the last year. It's gone from $4,700 down to about $2,500. And Fonterra, which is the big milk cooperative here, has come out and just this morning and said that it thinks that the payout to dairy farmers will be down. And again, that's just not helping confidence. And the New Zealand current account deficit at about 8% of GDP does require some adjustment at the moment as well.
So we're seeing a very weak New Zealand dollar at the moment, aren't we? It's trading, I think, around about 9-month lows right now.
Yeah, correct. It's gone from about 63 down to 59 against the US dollar. That's partly in sympathy with the Australian dollar, and it's partly because the US dollar has been so strong. But under 60, the Kiwi does seem fairly weak.
And what about over the sea in Australia, the RBA? We had the minutes of the RBA's meeting earlier this week. They seem to be encouraged by the latest inflation data there as well.
I think they're much more concerned about a recession in Australia than they are in New Zealand. This is the central bankers here, I think, are just much more focused on getting the figures down within the target range. Whereas in Australia, they've also seen a slowdown. They've seen some weak job numbers, and so again with the property market very important over there, just as it is here. The Reserve Bank seems as though it's going to be reluctant to increase rates further, and may look to start reducing them sooner rather than later. Whereas New Zealand quite definitely has said we're going to keep rates higher for longer.
Right. Is Australia, though, is it seeing maybe the first signs of a slowdown? Because we've seen the jobless rate rise. It ticked up to 3.7%, a sort of 3-month high. So that maybe there's a signal there that these rate hikes at last are starting to impact the jobs market, cause a slowdown in hiring, which then presumably will cause a slowdown in spending and a slowdown in the economy overall.
Yeah, and I think it also reflects the slowness of the Chinese economy. I think everybody was hoping for a big rebound, and in particular, the problems in the Chinese property market, given how much raw materials Australia exports up into China, that must be hurting both their exports from Australia and also the general job market and general confidence market.
And it looks like the situation in the property market is just getting worse and worse at the moment. It's ensnaring bigger and bigger property developers like Country Garden, and it seems to be spreading to the financial sector through these wealth management projects. Presumably, if it does get worse, this is also going to impact New Zealand and Australia.
Yeah, in fact, on the milk price. The last auction was extremely weak, and it was blamed partly on a lack of Chinese demand.
Right. And it's hard to see how that's going to come back at the moment, because there's such a big sort of crisis of confidence right now among consumers on the mainland. They're worried about the economy, about their house prices, about their jobs. It doesn't seem that this is going to bounce back that quickly. So presumably, in some of these Asian economies and over in New Zealand and Australia, we may have to be prepared for a long slog here.
Yes, I think so. Everybody expected a very quick bounce back, but unlike Europe, unlike the US, the mainland government hasn't had a big fiscal stimulus as a result of COVID, and so people don't have the built-up savings which they've been allowing to gradually diminish in places such as the US.
Right. And we had, from the US, we had the minutes of the Fed's meeting, the last July meeting, which markets seem to have been surprised about. And I have to confess to being a little bit surprised that the markets are surprised that the Fed just simply said, look, there are upside risks to inflation that could warrant some further monetary tightening. It almost seems, obvious, but nevertheless, the markets have taken this quite badly.
Yes, I think they have. Well, the equity market had done fairly well anyway, so we're due for a pause. But the bond market is the one which has really been affected. And I think what's happened is that it finally has dawned on people that inflation isn't going to come down in the US very quickly. And so if short rates stay higher for longer, then long rates have to creep up. And also for a long time in the US bond market, the term structure, which essentially means that you normally should get higher interest rates the longer you lend, that had been negative. And so now what I think we're seeing is that there's been a bit of a reversion to the norm in the fact that real rates are increasing at the long end.
Right. And of course, we've now got to get used to the fact that the 10-year is going to be above 4% for the first time since the global financial crisis on a consistent basis. That 4% now looks like a floor, doesn't it? Whereas it's been a ceiling for a long time. We're at 4.3% now already. This is going to have some big impacts, isn't it, on the financial markets?
I would think so. And the question is to really what should the real neutral rate be on a 10-year U.S. government bond if inflation goes to 2%? I mean, back before the global financial crisis, you normally assumed 3% real rates, which implies a 5% 10-year bond. And if we get there, then you're not going to see PEs of 25%, 25 times earnings, which you've had in the US. So we could be in for quite a long grind, I think, on on the potential for US equity markets.
Right. So, I mean, in effect, then, from what you're saying, it's we've got inflation in the US at 3%. In that case, bond yields could easily be around 5%. 10-year bond yields could easily be around 5% if you take sort of average economic growth.
Yeah, I think so. I mean, and we're only 70 basis points from that at the moment.
I'm not convinced that the markets are prepared for 10-year yields at 5%. Certainly not the equity markets, anyway.
I agree with you on that. Yeah, completely.
Okay, well, it's going to be interesting to see how this all plays out over the coming weeks, because we're in sort of a very interesting inflection point. Mike, it's always good to talk to you. Thank you very much for joining the programme this morning. That's Mike Gibbs-Harris, who is Director of MGH Asset Management in Wellington, New Zealand.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you to my guests this morning, and thank you for listening today and this week. If you want to get more details on some of the stories we've discussed this morning, please go to my website, peterlewismoneytalk.substack.com, and have a read of my daily newsletter. I'll be back on Monday when I'll be joined by Alex Wong, Director at Alex KY Wong Asset Management, and Alvin Chua, CIO of No International Wealth Management. And providing a view on mainland China will be writer and broadcaster Mark O'Neill. Have a great weekend.
Money Talk.